maybe we're not actually there, but maybe something else is happening. So, personal use, a personal use day would be any day that the taxpayer, member of the taxpayer's family, and they define family down here as brothers, sisters, spouse, ancestors, and lineal descendants. So aunts and uncles, I guess, don't count, nor do cousins. But days when the taxpayer, any member of the taxpayer's family, or any other person with an interest in the unit is at the unit. So if you like own it jointly with somebody else, that would be a person who has an interest in the unit. When any individual who uses the unit is under the arrangement that enables reciprocal use agreement, so like home swapping, so one family lives in Hawaii, another family lives in California, and they decide that they're gonna, for a week, they want a vacation, they just swap houses for the week, okay? That type of arrangement, it's as though the owner is there, so that's a personal use day. They're not getting any money for that time, anything like that. Any individual, unless for such a day the unit is rented for its fair rental value. So anytime you allow somebody to use it and you don't charge them for it, that's considered a personal use day. Okay. So any day, another factor, any day spent that is working substantially full-time on repairing and maintaining the property does not count as a personal use day. So if you're there fixing something up, it's not a personal use day, even if other family members are there using it for recreational purposes. So you've got a lake house and you've got family members there with you, they're at the beach, you're fixing, I don't know, the deck, something like that. That is not considered a personal use day, even though your family's there enjoying it. Okay, so we have to, just to kind of define what exactly is a personal use day for our purposes. Questions? We already went through all this stuff. So we got some examples here. Frank owns a condominium at the beach. He rents it for 90 days, uses it personally for 13 days. Okay, so if we go back to, find my chart here, and apply it. You can find that in the videos, lectures, and resources. All right. So, rents it for 90 days, uses it personally for 13 days. How many days is it rented? Well, it's rented for 90 days, so it's not personal. 10% of rental days is 9, but 14 is larger than that. So, is steps 3 result 14 less than the number of personal use days? So 14 is less than 13. So in this case, it's a rental slash person. They've got primarily rental. Why do they have primarily rental? Frank owns a condominium, rents it for 90 days, uses the property for personal use for 13 days. Oh, did I get this wrong? So, oh, it's not less, okay, I got the less than wrong here. So step 3 result is 14, less than, and the number of personal days used is 13. Sorry, I was thinking this was going the other direction. So the answer to that one is no, so it is primarily rental. Primarily rental. Next one, rents the condominium for 90 days, uses it personally for 16 days. All right, so 10% of rental days is 9, 14 is greater than that. So is 14 less than 16? Yes. So it's rental slash personal. Or personal slash rental, whichever one you want to put up first. Frank rents the property for 10 days, uses the condominium for the remainder of the year. this is a lot of words. Alright. Let's see. So let's look at these. So Jamie rented her lake home for $2,000 for 12 days. She and her family used it for the rest of the year on weekends and holidays. Well, 12 days is less than 15, primarily personal, right? So she doesn't have to declare that $2,000. Julie rented her home for 180 days. She used it for 17 days. So 180 and 17. So we're gonna have to continue on with this. Rental days, 18 rental days, which is larger than 14. So is 18 less than 17? 18 is not less than 17, so it's primarily rental. Darren beach house for 45 days. Stayed there on weekends with his dad for a total of 16 days. During his stay, he spent 7 of the days rebuilding the deck while his family enjoyed the beach. Okay, well, we can subtract those 7 days from the 16, so it's actually 9 days that it was used personally. So 45 days, 4.5, 14 is larger. So is 14 less than, what do we have, 9? No, so it's primarily rental. Last one, Alex rented her mountain cabin for 90 days. She and her family used it for 50 days. Alright, so 10%, 9, so 14 is what we're gonna use here, the larger of. So is 14 less than 50? No, primarily rental. Okay. All right, so how do we allocate the expenses? So we've got this property that's personal / rental. We've got expenses that are applied to the whole house, right? So how do we allocate those expenses? So there are 2 ways to do it. The IRS method and the tax court method. Is this going? It is going. So with the IRS method, what we're taking is the number of days rented divided by the total days used. So that might not be 365. Right? It might be some other number, times the expenses, all of the expenses. So for example, if we have, so let's say we have rented total, rented was 30, total days used was 120. And we've got mortgage interest of $7,000 that was paid on it. We've got let's see, taxes of $2,000. We've got utilities, $2,000. And what other kinds of expenses would we have? Taxes, interest, all maintenance. In total of $2,000. All right. We would take, so our total expenses here are 7, 8, 9, 10, 11, 12, 13,000. We would take 30 divided by 120, which is what, is it 25%? We would take 25% of this. And this is for the rental portion. Okay, so let's see, 3,000. 250 would be our total expenses for the rental part of it. This is the IRS method. The tax court method does it a little bit differently. It still applies this ratio to the utilities and the maintenance, 30, 120, 30, 120. So we've got, what, 500 here, 500 here, for 25%. But these two, we're gonna use a different ratio. So for the tax court method, we're gonna take the number of days rented. You can see that up there, I'm not gonna repeat it. So we've got 30 days divided by 365. So the portion of the entire year. The thought behind that is that mortgage interest and taxes continue whether or not you're in it or not. You still have to pay them, right? They're fixed. Whereas these are variable types of costs. Utilities, yeah, you're still gonna have to pay at least to have it hooked up, but that utility bill is gonna go down when nobody's in there, right? Maintenance, you're not really gonna maintain it while you're there. That type of stuff only happens while you're actually using the facility or the home. So, what is 30 over 365? Somebody do that math for me. So 8%. So this 9,000 times 8% is how much? What's 9,000 times 0.08? No.
9,000?
9,000 times, what's 8% of 9,000?
720.
720, okay. All right, so in this case, for the tax court method, it would be 1720. For the total expenses. Okay? That is up on Blackboard as well. In the same location. So we've got here tax court method, you've got two different calculations. We'll take the number of days rented divided by 365 times the taxes and interest, and plus number of days rented divided by total days used. The same method is up there for everything else. And then add them together, right? Questions about that? All right. Okay. Now they do have to be applied in a particular order. It kind of works like the home office. So first you're gonna take the mortgage interest and the property taxes. So we're talking here about, you know, when you can't take all of the expenses because it's rental / personal. So we're gonna take the mortgage interest and property taxes first that are directly related to, and expenses that are directly related to the rental property. So we may have expenses that obviously are only related to the rental property. They use the example up here of management fees. When you're using the home personally, you're not paying management fees. The only reason you have those management fees is because you have a rental property, right? Advertising would be another good example of that. You're not advertising it when you're there yourself, you're advertising it as a rental. So mortgage interest, property taxes, and expenses that are directly related, so direct expenses. Next would be indirect expenses, utilities, insurance, and repairs. Last comes depreciation. You can still depreciate it because you're using it as a business. You would depreciate only the portion of it. You would have to only the portion when it's being used as a rental, right? So if it's being used as a rental, 10% of the time, you'd figure out the depreciation on the full depreciation and only take 10% of that. But that comes last. Okay? Questions about that? So I think you do have in this chapter in your shoebox to software, you do have a rental. So you can see kind of the difference here. They've got an example of the difference between the tax court method and the IRS method. Now you would think at first glance that the tax court method in this example, well, they're both actually going to end up being the same, because this is the depreciation. Even though if in full it's $17,290, we can only go to, we can't have a loss if it's rental / personal, right? So they're limited to how much depreciation they can take. So their total expenses are going to equal whatever that income is, which, what, $21,600. Now, but remember, they cannot take all of their mortgage interest here, because they can only take a portion of it, but the rest of it is gonna go on Schedule A. So they've got this amount that is deductible on the Schedule E, and then the remainder is gonna be deductible on the Schedule A. But the tax court method, we have actually a lesser amount that's deductible on the Schedule E, and a greater amount that is deductible on the Schedule A. So for this method, the tax court method, you're actually going to end up overall with a greater deduction, because you're able to offset all of that income on the rental. You're still not able to take all of the depreciation, but you're taking more of the depreciation. But you're able to take more of the property taxes and mortgage interest on the Schedule A. So overall, you're gonna get a greater deduction on the tax return. So here, the deduction is, well, if we added those up, it's $21,600 plus $270 plus $789. So let me get the calculator. I'm gonna illustrate this. So 270 plus 789, that's what's gonna go on the Schedule A, plus all of these totaled up is 21,600. So you get a total deduction of 22,659 with the IRS method. But with the tax court method, 21,600 plus 1,001 plus 2,925, you get $25,526. Simply because you're able to still use the mortgage interest and the taxes on the Schedule A, whereas all those other expenses you can't. Does that make sense? Just kind of point out the tax court method, even though it looks like it might be stingy, because you're not getting as much of a deduction on the rental. In this example anyway, they're getting the same deduction on the Schedule E, but they're getting more of a deduction on the Schedule A. Questions about that? All right. So what we have talked about so far is when we have one property that is used differently at different times during the year. Right? So we're dividing up the year between personal use and rental use. Well, sometimes we have properties that for the full year are being used for both. So now we're not dividing up the time, we're dividing up the property itself between personal and between personal and rental use. So what do we do then? This as well sort of works like the home office deduction, in that you are going to any expenses that are directly related to the rental portion will be directly deductible from the rental income. So for example, if you've got, example of this is you've got a 3-bedroom house and you rent out one of the bedrooms. Okay, so for 100% of the year, you're living in the house, so it's being used personally, but for 100% of the year, you've got a renter as well who's paying you for part of the house. So those expenses that are directly related to the rental portion, so let's just say you had to do a repair on a window in the bedroom. That's directly related to the rental. Advertising, again, if you had to advertise to get a tenant, that is directly related to the rental. Those expenses would be 100%, you'd be able to expense them 100% off of the rental income. However, other expenses that apply to the entire house, you have to allocate. Partially to the rental, partially personally. Things like mortgage interest, right? Property taxes, utilities, if you're paying for the utilities, other types of expenses that would apply to the entire house as well. And you do it based on square footage, just like we did with the home office deduction, right? So if we've got a home, oh, that's so wet. Oh, that's not gonna take a little while to dry. Okay, so if we've got total square footage is 2,000, and you're renting a room, so the rental portion is maybe 200 square feet. We've got mortgage interest of 5,000, taxes of 2,000, utilities of 2,000, and then we had a repair that is 100% rental of $200. So we would take 200 is 10% of the total square footage. So we're going to multiply each of these by 10%. So we've got what, 500, 200, 200, but this is going to be 100% because it's directly related to the rental. So our total expenses are going to be $1,100 for the rental. Okay, just like that home office. That make sense? Questions? No? I erased it. Oh my gosh. Maybe I'm just not strong enough.